Imagine possessing a mere $10 that could transform into millions. Sound like magic? It's actually the power of compound interest. This incredible financial tool can turn small savings into massive wealth. It's a key to financial success, and understanding it could be your ticket to a future of prosperity. So, ready to discover the secret behind this financial wizardry and find out how you can harness the power of compound interest to reach your financial goals? Buckle up, because today you will learn how compound interest can help you become a millionaire and how long it will take. And I also invite you to like this video, subscribe to our channel, and turn on the notification bell to get more valuable ideas on how to achieve financial freedom and prosperity. So, let's get started. Before we dive into how you can become a millionaire, it's crucial to understand what compound interest is. Unmasking the wizard, compound interest isn't rocket science. It's all about your money making more money. Compound interest is like a snowball effect for your money. It's interest that gets added to the initial amount you save or invest, and then it keeps growing based on both the initial amount and the added interest. Over time, you earn interest on your interest, which accelerates the growth of your savings or investments. Imagine you're planting a tree. You water it, give it sunlight, and over time it grows. Not only does the tree grow, but it also produces seeds. These seeds fall into the ground, develop roots, and become new trees themselves. This process continues, and before you know it, you have a whole forest. That's the magic of compound interest. It's not just your initial investment that grows. The interest you earn also starts earning interest. The longer your money stays invested or saved, the more powerful the impact of compound interest becomes. Let's break it down further. Say you invest $1,000 in a low-risk exchange-traded fund or ETF that provides a 10% return per year. After the first year, you earn $100 in interest, making your total investment $1,100. The following year, you're not just earning interest on your initial $1,000, but also on the extra $100. So your interest for the second year would be $110, and your total investment would be $1,210. This compound interest process is repeated annually, allowing you to earn profits based on previous earnings. This may not seem like much initially, but over time, the effect is significant. The more time your money has to grow, the more you benefit from compound interest. That's why I propose to consider the role of time in building your wealth with compound interest. Time, the secret ingredient in the recipe of compound interest. Now you may wonder, what does time have to do with money? Well, in the world of compound interest, time is more than just a tick-tock on the clock, it's your most valuable asset. The more time you give your investment to grow, the more periods of compounding it experiences, and the larger your wealth becomes. It's not linear growth we're talking about here, it's exponential. It's not about adding, it's about multiplying. Ever wondered how long it would take for your money to double? Discover the Rule of 72. The Rule of 72 is a simple but powerful concept that can help you estimate the time needed for an investment to double its value with compound interest. It's like a secret decoder ring for your finances, giving you a quick and easy way to peek into your financial future. Here's how it works. You simply divide the number 72 by the annual interest rate your investment is earning. The result is an approximate number of years it will take for your investment to double, thanks to the magic of compound interest. Let's say you have an investment earning an 18% annual interest rate. Using the Rule of 72, you'd divide 72 by 18, which gives you 4. That means it will take about 4 years to double your investment. Of course, the Rule of 72 is a simplification, and it's not always exact, especially for higher interest rates or longer time frames. It's a rough estimate, a ballpark figure, but it's incredibly handy when you want to get a quick understanding of the potential growth of your investments. So, the Rule of 72 gives you a quick peek into your financial future. Always remember, the power of time works both ways. The sooner you start investing, the more time you give your money to grow. But every moment you wait, you lose potential compounding periods and your potential wealth diminishes. So, whether you're 20, 40, or 60, it's never too late to start. Invest today, let time work its magic, and watch your wealth grow exponentially. Remember, in the realm of compound interest, time is your best ally. The concept of compound interest serves as a compelling reminder of the value of time in financial decisions. It emphasizes the rewards of patience, consistency, and long-term thinking in building wealth. Time, when coupled with the magic of compound interest, has the power to transform small investments into substantial assets, making it a crucial ally in the journey toward financial security and growth. Consistency plays a vital role in harnessing the power of compound interest. Regular contributions, no matter how small, can make a substantial difference in the long run. Setting up automatic transfers or deductions from your income to your investment accounts can help maintain this consistency without much effort. Even during market fluctuations, continuing your contributions can lead to buying assets at lower prices, potentially increasing your overall return when the market rebounds. The discipline of consistent investing, combined with the effects of compounding, is a formidable wealth-building strategy. Let's imagine you invest $200 per month into a portfolio that averages a remarkable annual return of 20%. Here's how your investment might grow over different time frames. In 5 years you will have about $20,000. After 10 years, approximately $76,000. And the mark of $1 million by investing $200 can be reached in about 22 years. Yes, 22 years is not a short period of time, but remember that in this example, we're investing a relatively small amount, $200. Now let's consider an example of investing a larger amount, say $1,000 per month, at a 20% annual rate. With such an investment, you'd become a millionaire in approximately 14 years. Investing $5,000 per month would get you there in 7 years. Even through these calculations, you can understand the power of compound interest in time. This power allows for the accumulation of substantial wealth even with relatively modest savings. Even with consistent but relatively modest contributions, the extraordinary growth potential becomes evident. Consistent investing coupled with higher returns can indeed expedite the journey toward financial goals, but it's equally important to approach such investments prudently and diversify to manage risks effectively. While compound interest does the hard work, choosing the right investment instruments can amplify its impact. Consider investments that offer high returns over time, such as stocks in companies like Apple, Amazon, Google, and others that yield annual returns of more than 30%. ETF index funds, which contain stocks of hundreds of the most successful American companies, are a great choice for those who prefer more conservative investments. Consider investing in ETFs such as the S&P 500 or NASDAQ 100. These funds give you access to a wide range of companies from different sectors of the economy, such as technology, finance, healthcare, and others. These funds are popular among investors because they allow you to gain exposure to a wide range of companies and diversify your risk while providing the opportunity for investment growth on a long-term basis through the power of compound interest. Reinvesting the dividends paid quarterly by the companies whose shares are in your portfolio, as well as the interest you earn from the company's growth, can further accelerate your wealth accumulation. It is important to understand that higher incomes are usually associated with higher risks. Before making any investment, it is important to conduct a thorough analysis and consult with financial professionals to avoid possible risks and maximize your returns. So, how does compound interest pave your path to becoming a millionaire? Well, if you've been following along, by now you know that compound interest is like a snowball rolling down a hill. It starts small, but as it rolls, it picks up more and more snow, growing larger and larger until before you know it, you've got an avalanche on your hands. Now let's apply that to your financial goals. Imagine you're starting with a small snowball, say, a consistent savings plan. You decide to put aside a certain amount monthly. This is your principle, the core of your snowball. On its own, it might not seem like much, but then compound interest comes into play. Your savings begin to earn interest. And here's where the magic happens. That interest isn't just added to your principal, it too starts earning interest. This is compounding. Your earnings are reinvested, creating more earnings. It's a virtuous cycle that can lead to significant growth over time. But remember, this is not an overnight success story. It's a tale of patience, discipline, and wise investments. It's about understanding the power of time and letting it work in your favor. And it's not just about saving. You can accelerate your wealth creation by investing wisely. Stocks, bonds, real estate, mutual funds, there's a world of opportunities out there. The key is to pick investments that provide a good return and let the power of compound interest do its thing. Finally, be consistent. Consistency is the fuel that keeps your snowball rolling. Keep saving, keep investing, and keep letting your money work for you.